Hello everybody, and welcome to the February Kluge Wealth Advisory Group monthly client video. In this month's video, we'll be covering off 4 segments. We'll be doing a market review, a portfolio review, we'll be touching on some wealth planning questions, as well as addressing your frequently asked questions. Now, as a brief reminder, on February 6th, we held the second installment of our estate planning webinar series, and this time we covered off some issues pertaining to insurance. And you can find that webinar, as well as all of our other content, on our YouTube and X channels. Thank you very much, and let's get right into it. In terms of markets in February was a tougher month than January for sure. Major indices churned around their highs, although they did retreat somewhat. And we did see a broad-based retreat, both in growth and value-style stocks, although value-style stocks did go down less than growth for sure. Now, in terms of sectors, we did see a particularly defensive rotation, with consumer staples and real estate leading, and the industrial sectors and consumer discretionary sectors lagging. Now, this would be expected in this type of a market environment, so there's nothing unusual there. There's also nothing unusual with the market having a tougher time in February, especially in post-election years. In fact, based on data from the Stock Traders Almanac, February is actually one of the weakest months of the year in the US election cycle when you're in the first year of any president's term. So what we're seeing now is actually, frankly, very, very historically normal. Now, in terms of broader markets, we did see interest rates continue to fall in the US with benchmark yields declining, as well as the US dollar index fell over the course of the month. And commodity prices continued to rise slightly, although again, nothing outsized there and nothing really of note. Now, in terms of portfolios in February, there's a number of things I wanted to touch on. The first is that, like markets, portfolios generally declined over the course of the month to one degree or another, depending on their risk tolerance. The second is that we conducted our quarterly portfolio reevaluation and rebuild, and that resulted in several changes. The biggest of these changes was the disposal of names like Caterpillar, Eaton Corporation, Block Inc., and Cameco, and the replacing of those names with an increased weight in the BMO US Equal Weights Bank ETF. We introduced a position on John Deere. We introduced a position in S&P Global, which is a name that we've held before in the past. And we also introduced a position in 3M. Now, the main driver of these changes was that the names that we got rid of, Cameco, Caterpillar, Block, those names triggered one of my technical sell signals. So we want to make sure that we are owning high quality stocks that are in a persistent uptrend. And if that uptrend appears to be violated, then we have to make an investment decision. So in those cases, those names all appear to have been flattening out with a negative bias, and that's not what we want to be owning in the portfolio. On the other hand, there was other healthy stocks, such as John Deere, such as S&P Global, the BMO Equal Weight Bank ETF, and as 3M, that had all broken out of lengthy bases. Now, when stocks break out of lengthy bases, that is usually a technically positive sign. So if you have a high quality stock that appears to be entering a new uptrend, that is definitely something you want to own over a high quality stock that appears to be entering an extended period of consolidation. For this month's wealth planning segment, we want to touch on a topic that I know is near and dear to everybody's hearts, and that's your annual income tax filing. Now, in terms of this year's tax filing, there's a few things we'd like to note. The first is that, as in past years, we will be producing a tax package, and we're happy to deliver that to either you or your CPA. The second is that the deadline for all of the issuers to get information to us is March 31st. So in order to ensure an accurate package, we do need to wait until after that date to make sure that we are giving you the best information possible for your tax filing. Third, the CRA does not appear to be enforcing the new rules that they proposed around capital gains inclusion. Now, of course, we'll always defer to your accountant's opinion on this, but based on top memo papers that the CRA did publish, they're not going to be enforcing this for this 2024 tax year. And the final point I want to touch on was related to accounting for gains and losses. Now, in speaking to our CPA contacts, it's widely acknowledged that the T5008 slips that come out are not accurate, and CRA is aware of this. And so for this reason, as well as other reasons, it is perfectly acceptable to report your realized gains and losses as a single line item, as long as you retain the records. Now, of course, we will be providing you those itemized and total records in your tax package, and in addition, Kluge Wealth Advisory Group and Wellington Private Altus will also be holding on to a copy of this, for future years. So if you have a question on any of these points or anything else related to your tax filing, please give us a call. We're here to help you. All right, we're back, and let's get into talking about some of your most frequently asked questions. Now, over the course of my client conversations the last month, there was again a persistent theme in our conversations around Trump, tariffs, and all of the potential impacts. So I wanted to make sure that we were spending a little bit more time talking about that here today. And anytime we bring Donald Trump to the conversation, I always want to leave with the warning. Maybe warning's the wrong word, but I think the right word just could be the note that I'm discussing things from the perspective of the portfolio and from the perspective of markets, and definitely want to keep personal feelings as far away from this as possible. So again, my only goal here is to provide analysis and observation. I am not here to provide any punditry for or against any one particular point of view. So the most common question, or I would say observation, or I would almost feeling that was shared with me with clients over the course of the last month is that, they really come down to clients, noting that everything just feels very, very disjointed. And I definitely agree with that. Everything does feel a little bit disjointed right now. And it's like the box is being shaken, like someone's trying to find the prize in the bottom of the box of cereal. Now, we also want to put this in historical context. I did reference earlier in the video the data provided by the Stock Traders Almanac, which clearly indicates that the February of a president's new term is usually a very, very volatile month, and for some indices, the worst month of the year. Now, I think so we don't want to assign any magical powers to Donald Trump here. We have to remember that it doesn't matter who won. If Kamala Harris was president today, it would be very likely that there would be some volatility here as she started her new term. And so I think that that's a major driver, is a lot of this is just plain normal. Now, some of this is also, I believe, enhanced because of the speed at which the Trump administration is moving. They seem to be moving at the pace of Silicon Valley, which is fast by the standards of business, and business is fast by the standards of government. So if it seems like a lot is happening, I'm going to say, yeah, it is. You have fast-moving Silicon Valley entrepreneurs helping to drive the agenda. And, because of this, it really, it appears to me that the Trump administration is operating on the theory of what's called the 100-day presidency, which basically says that from inauguration until the summer recess, whatever it is you want to get done, you'd better get that done in that first initial period, that 100 to 120 days of your presidency. And after that, who knows what can get done. So I think that as we go forward, things will calm down and the pace of change will abate. However, we also want to remember that this is completely normal in a historical sense, that there is some churning in markets. And the fact is that we are churning near highs. And so I think that's very important. So when you really think about it, the disjointed feeling we're getting is just more of a manifestation of adjusting to new change. And I think I'm going to credit Dave and Jackie here for giving me the line that says basically it feels worse than it is. So thank you, Dave and Jackie, and we'll move on to the next question now. In the previous question we addressed, we dealt with that disjointed feeling that many folks are having these days. And that discussion around that disjointed feeling, of course, led to another question, which is, does this affect our 2025 outlook? And the answer is, at this point, not yet. Now, even if I put things in the most negative light possible, all that's happened is portfolios have risen slightly over January and then retreated in what is usually a very volatile month in a post-election year, in February. So the worst thing that's happened is that we've gone back to where we were at the end of December in 2024. Now that's despite multiple, what we call in the business, tape bombs. You have tariff tape bombs, you have DeepSeek, and you have other issues that have rattled the market. And yet the markets and portfolios still persist in and around their highs. And this is where I want to bring back an old Wall Street saying, which says that something that doesn't go down on bad news isn't bearish, or put into another way is that something that doesn't drop when the news is bad isn't something that is likely to drop very far. Now, of course, I could be very wrong on this, and old Wall Street aphorisms are you're certainly not trying to predict the future. But we also have to remember that as of the filming of this video, markets have displayed an enormous amount of strength in the face of what are some could be considered very, very negative headlines. So I think that's a major takeaway. The other thing is that none of the things that we've seen this year have invalidated any of the positive quantitative signals that we've seen at the beginning of the year. Now, the one example I do want to always cite is the January barometer because it is the most researched. And that one just says that if the stock market is positive in January, the chances of the market being up for the full year are 91% with an average return in the mid to high teens. So that signal certainly hasn't been invalidated. And what we've seen is what is a historically volatile month be volatile. So the biggest risk that I do see out there just continues to be Doge. Now, the Department of Government Efficiency is really an austerity program. And if they move as quickly as they appear to want to move, then you could see a significant reductions in US federal spending into the end of this year, which would create a headwind for US growth as we look out 5 or 6 quarters. However, we're not out there yet. We're too soon in the process to have enough data in order to make a data-based decision. And we don't want to be reacting based on emotions like fear and greed. We know that that is also the path to ruin. So we'll have to wait to see the way things look. And the other thing is that there's also a positive case out there. There's an enormous amount of investment being done in AI, both by AI companies as well as businesses in general, which are looking to adopt these technologies. And one recent headline, of course, is Meta did announce that they're building a $200 billion supercluster of processors. Now, that is an enormous technology spend that they would not be doing if there wasn't a demand for that type of a product. So that type of technology spending could easily and potentially overwhelm any government spending cuts. So that's something we have to keep in mind. There's a positive case, there's a negative case out there. There are quantitative signals that are very positive, and despite the, as I mentioned, the aforementioned tape bombs that have hit the market in the last 8 weeks, all we've done is basically churn around the highs. So at this point, no changes to the 2025 outlook. However, I am forever vigilant, and if the information changes, I am proud to say that I will change my mind. Another question that came up frequently in my client conversations over the course of last month revolved around the impact of tariffs on portfolios. So this is, of course, a complicated question because tariffs are not a simple thing to work out. However, what I would like to say is that given the fact that most of the business risk or most of the equity exposure in the portfolio is US, there's very little direct risk of tariffs to our portfolio. Now, I of course want to separate this from our personal risks as Canadians. However, from the perspective of the portfolio and being invested mainly in US equity, there's not a lot of direct risk there. Really what I'm going to say is that any risk to the portfolio really more revolves around headline risk and the creation of, again, what we call in the industry tape bombs, which could cause bouts of fear or anxiety in the market. So that we kind of get away from, but we don't really own any businesses that I'm aware of that would really be super exposed to potential countervailing tariffs coming from Canada, the European Union, or any other power. So I think from that perspective, direct exposure low, indirect exposure potentially, but then that's true for everything that is in the capital markets. Another question that we saw over the course of the month was whether or not inflation would be caused by tariffs or tariffs would cause inflation. So the answer to that one is that it is a complicated answer. And I can't go into all of the details here, but I did want to at least open up the conversation here to some of the things that we have to consider. Right? The first thing that we have to consider, and this is very important, is the idea that a one-time adjustment in price or change in price is not inflation. It's a one-time increase in price. And a tariff is a one-time increase in price. So if we look at the definition of inflation, it is a persistent, broad-based increases in price across an entire economy, and a tariff on goods causes a one-time price adjustment in the economy. Now, I can imagine a scenario where perhaps tariffs are put on and then ratcheted up over many, many, many quarters, and then in that situation you could make the argument that tariffs cause inflation. However, that doesn't seem to be the scenario that's on the books right now and put before us, but I also do want to acknowledge that. The other thing where this starts to get more and more complicated is that there's a number of impacts and effects that we have to think about. The first one is substitution. Is the good that's subject to tariffs easily substitutable? For instance, if I'm an American consumer, I can choose to buy a Korean car, I can choose to buy an American car, I can choose to buy a European car. And if a European car goes up in value, I can go and choose to buy a Chevrolet or a Hyundai as opposed to a BMW. Now, that may not be a great example, and I fully acknowledge that, but I just want to illustrate the point is that substitution is a major impact on whether tariffs are actually, would provide a generalized catalyst for price increases. The second thing we have to remember is that currencies adjust. And if you're subject to tariffs, your country's currency will go down. For instance, a US tariff on Canadian goods would cause, all else equal, the Canadian dollar to fall versus the US dollar. Another thing we have to remember too is that the economies are highly competitive, especially in the United States and in Canada as well. It's a competitive market to sell goods, and companies may not be able to pass on that full price increase. So these are all confounding factors that make the answer, are tariffs inflationary, quite complicated to answer. It is a complex system, and the only comment I can leave is that if tariffs are inflationary, Canada is much more vulnerable to that than the United States. And the reason for that is that only about 15% of American goods and services are imported. And based on some work done by Dr. James Thorne, which is based on a number of assumptions, of course, he estimates that the impact to US consumers of a 25% universal tariff on all imports would be a one-time price increase of 1%. Now, that number is, of course, an estimate, and even if it's off by a couple orders of magnitude, it's not 1%, it's 3%. It's still not a spike of inflation to 2022 levels, and certainly not to the very dizzying high numbers we saw in the 1970s. So we have to keep all this in mind, is that it's a complicated picture, and the United States is not really that vulnerable to tariffs. Canada, on the other hand, the impact could be large, right? Both from lost business and then also inflation caused by us importing goods with a depreciated loonie. So these are things that we have to bear in mind as we work this out. And that's also why it's important to note here that, again, portfolios are not orientated towards Canadian equity, which should be more vulnerable to that. They're orientated towards US equity, which is less vulnerable to that. So I'm always happy to go into this. There are some other nuances we can discuss and some other moving parts inside of the portfolio that definitely have an impact here. But just want to, again, just share with these three thoughts. And the first thing, of course, is tariffs on a technical basis are not inflationary because they're one time. And the second thought is that we do have to, there's a lot of confounding factors, and it's very difficult to figure out to what extent are tariffs going to create a sustained increase in prices because of effects like substitution, which get stronger with time, the effects of currency adjustments, which get stronger with time, and the effects of companies not passing on that price increase. So these are all things we have to bear in mind and all things that we have to watch. And trust that we will remain vigilant and make adjustments as necessary as we would against any potential threat or opportunity. And as always, again, I want to leave this question off with, if you have any questions or things you want to go over in relation to your personal situation or the portfolio, please let me know. We're here to get the job done, and we're here to talk. Wrapping things up here for the Kluge Wealth Advisory Group Client Monthly Update video, we talked about a wealth planning topic related to tax season. We discussed portfolio changes. We reviewed the markets in February, and we discussed your frequently asked questions. So if you have questions on this or anything else, please reach out, give us a call. We're here to help. And again, a brief reminder that all of our webinars and all of our content are available 24/7 on our YouTube and X channels. Thank you very much, and we'll look forward to speaking with each and every one of you soon.